Hi folks, welcome to this video which is going to demonstrate issuing shares and preparing the equity section of the balance sheet. We'll also calculate an average issue price per common share and actually add a section where we have to do the statement of changes in equity. So let's have a look at our question here where we have a company, Westby, and they were authorized to issue an unlimited number of common shares, and we need to know that because in the equity section of the balance sheet we need to show that with the common share account that we're going to list there, the authorization limit. So we need this information. Now it told us that during the current month of January, we had some transactions where shares were issued, and you'll notice that happened on January 1st and 5th. We also declared a dividend on the 15th. We also issued some more shares on the 20th, but not for cash, for land. And then we had to close the income summary account, which would update retained earnings on January 31st, and also pay out the dividends that we declared on January 15th. We need to make journal entries for all of those things, do the equity section of the balance sheet, calculate the average issue price per common share, and then I'll add a Part D here, which will show you how to prepare the statement of changes in equity. So notice in the first transaction here, 1,000 shares were issued to the organizers of the corporation. This would be those folks like accountants and lawyers that help you set up your business. We said in class that we're going to debit the organization expense and credit common shares for that value of $12,000. So we paid the organizers not in shares, but we didn't take cash from them. It's basically their services, and because they're startup services, we call them organization costs or expenses. So now, what we need to do is you need to think about the fact that you have to do the equity section of the balance sheet for the company. So we need to track what's happening in the common share account because that's an equity account. So what I'm going to do down below here is track. I've got it here in the calculation section. We're going to track the number of shares that are issued all the time, 1,000 shares in our case, and $12,000 because we need to know the number of shares issued and outstanding in the equity section, and we need to know how much new equity is created in common shares. So that's why we're tracking. You'll notice here now on the 5th, we issued 15,000 shares to regular shareholders for $13.50 each. So if we do the multiplication, we can see that our common share equity is going up, and when an equity account goes up, we credit it. And that would be for $202,500 when we do the multiplication. And in this case, our shareholders are giving us cash. So again, we're going to track the fact that we've issued 15,000 new shares and created new common share equity of $202,500. Now it says here the board of directors on the 15th of January declared a cash dividend of 75,000 a share, 75 cents per common share to the shareholders of record on January 19th. Now, notice it's not being paid out now. It's going to be paid out at the end of the month. Well, you got to make a journal entry to record the declaration at the 15th. So two things you know. You know that you're going to pay a cash dividend of 75 cents per share to the shareholders on January the 19th. And you know that whoever's out there on the 19th, right? Because you look here, on the 20th new shares were issued, but between the 15th and the 19th, there's no new shares issued. So you know you're going to pay 75 cents a share to the people on January the 19th who hold the shares, and at that date, you're only going to have how many shares issued and outstanding? 16,000. The 1,000 issued on January 1st, and the 15,000 you just issued on the 5th. Because after that, on the 5th, no new shares got issued till the 20th. You're going to issue them based on how many shares are issued and outstanding on the 19th. So, again, you can go back to your calculation here. You know that on the 19th of January, you only got 16,000 shares issued and outstanding. So, the dividend on 16,000 shares at 75 cents a share is going to be 12,000. So you're going to credit your common dividends payable because you're not paying out the dividend yet. You're going to pay it out on the 31st. And so now you got to debit something. Most of the time you would see we debit cash dividends, which is your dividends declared. But you can debit retained earnings directly. If you debited retained earnings directly, what would happen? Well, then, you don't have to do the closing of the cash dividend account. But if you didn't use retained earnings, then you would debit the cash dividends declared account, or cash dividends, which you would have to close at the end of the period. But in any case, we're going to debit either of those two accounts. You have a choice here because they didn't tell you which one to do. And you're going to credit cash or common dividends payable for $12,000. Now notice on the 20th, you issued 4,000 new shares in exchange for a piece of land that had a book value of $48,000, but they don't know the fair value, right? So nobody went out and determined the fair market value of the land. So therefore, because we don't know the value of the asset land that we're getting, we have to use the value of the shares that were issued to value the land in the transaction. Normally, we would value the asset received to help us value the common shares issued. But because we don't know the market value of the land, we have to use the market value of the shares. And we know that's $11.50 a share. So 4,000 times $11.50 is going to give us $46,000 as the value for the common shares issued and $46,000 for the land. Because again, we don't have a fair market value for the land. So we have no alternative but to use the value of the shares. So now again, if we update, we see we're issuing 4,000 shares, and the value of those shares is going to be $46,000. So now, if we go back, now what did we do? The last two transactions say here we close the income summary account, which is a credit balance of $165,000. When the income summary has a credit balance, remember, that means revenues were bigger than expenses on the income statement, so we had profit. So if we're going to close out that profit showing in the income summary as a credit of $165,000, we know profit increases retained earnings. So we're going to debit the income summary account to zero it out or close it out, and we're going to credit retained earnings. So for $165,000. And then they also told us here that the dividends declared on January 15th, which we said were $12,000, we're going to pay them. So we're going to get rid of that common dividends payable. So now we debit the common dividends payable and credit cash, $12,000. Now, I just made a note here. If we had used the cash dividends only, so remember here, let's say we didn't use retained earnings. Let's say the question said use the cash dividend account. It didn't, but let's say it did. Then you'd have to debit the cash dividends and credit the common dividends payable. But then the common cash dividends would have to be closed or zeroed out. So we would credit it because we would have debited it up here, right? And then we'd have to debit the retained earnings by $12,000. They didn't say that, but if you had done it this way and not used that guy, say you didn't use that guy, right? Then you have this account, then to zero it out, you credit it and you debit retained earnings, right? So now, if we had to do the equity section, the calculations that we did here are going to help us. Why? Because in the equity section of the balance sheet, when don't forget, all balance sheets are done at a date. We're only doing a partial, the equity section, but we'd have to show common shares, authorization limit, which the question told us up here was unlimited, right? Unlimited. And we know we have 20,000 shares outstanding because we've been tracking it. And don't forget, January is the first month of operations, so we didn't have any common shares outstanding at the beginning. But we created new common share equity totaling $260,500. So that's all we have, right? So calculation 1 here gives us this and this, right? The retained earnings now, how do we know that? Well, it's $153,000. How do we know that? Well, don't forget, you credited the retained earnings when you closed out the income summary for $165,000. But don't forget, dividends reduce retained earnings, right? So dividends would be of $12,000 would reduce that. How do we know? Well, don't forget, up here on January the 15th, okay, if you would use the retained earnings account and not that guy, right, you would have debited it. So it would have reduced it. And if you didn't do that, and if you didn't use this guy, whichever way you did it, you then would have had to close out that cash dividend account to retained earnings, which in either case is going to reduce it. So that would reduce it to $153,000. So you'd get total equity of $413,500. Now, what's the average issue price per common share, which is what they asked you to do in Part C? Well, you're going to take the total amount of common share equity from the equity section of the balance sheet and divide it by the number of common shares you have. So you use your equity section to help you calculate the average issue price per common share. And what does that mean? For every share you issued, on average, each shareholder gave you $13.03 a share on average. Don't forget, for 1,000 shares, you got $12 a share. Okay, for 15,000 shares, you got $202,500. So it's a different amount per share, right? It's all varying. But on average, they gave you $13.03 a share. Now, the new part, what if I said to you, do a statement of changes in equity? Well, what you'd have to do here now is, and again, don't forget, a statement of changes in equity is done for a period. In this case, it's only the month of January. So we're going to look at all of our equity accounts. We only have common shares, retained earnings, and then we're going to total. So at the beginning of January, we had nothing because it's the first month of business. What changed equity? 3 things. The total dollar value of shares you issued, profit you earned, and dividends you declared. So the total dollar value of the shares we issued, $260,500. Don't forget, when you issue shares, it doesn't affect retained earnings, right? So we're creating new equity of $260,500. Profit doesn't affect your common share equity, but it affects retained earnings. It increases it. So you increased your equity by $165,000, and the cash dividend you declared, it doesn't affect the dollar value of the common shares out there, but it does affect retained earnings because it reduces it. Dividends are declared out of retained earnings. So that decreases your equity. So now you'd have $260,000 in common share equity at the end of January. You'd have retained earnings of $153,000. So these two numbers together are $413,500, and these 3 numbers here in the total column would also give you $413,500. And notice again, normally we would do the statement of changes in equity before the equity section, and these down here would be the numbers that we would put in here. So this concludes our video on issuing of shares, dividends, and the closing process along with some of the statements. I hope you found this helpful.